let's put the bigger picture into context. And it's mind-boggling when you really drill down into it.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. And Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We bring you exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and I'll be your host for this week's episode. And we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. So get ready for another packed episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media just will not provide. So just before we head over to the UK, please help us keep spreading the word about this channel by hitting that like button right now. You can do it right now too, and share this information, and also subscribe if you haven't already done so. It really helps the channel grow even more. And if you click on that bell right there, we'll notify you as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, as you've been saying, with the Fed being the only global central bank defending the dollar against gold, as you expected, they're resorting to the only trick left in the synthetic playbook, which is to maybe try rinsing out as many naked long speculators as possible so as to cover off their deeply offside derivative bets against gold. And as you say, they are restricted now as to how many of these speculators they can rinse out before they expose themselves to the relentless central bank physical buying that they cannot offset in the paper markets. Now, it looks like this is underway. Can you tell us what's going on here? What are you seeing?
Yeah, great to be with you again, Shane. Thanks for all the questions, people. Really appreciate them, because obviously we're trying to make as much of these episodes as possible and really just to get those questions answered. There's a million of them, and obviously we have to kind of hone them down so we can fit it in a session. But Shane, absolutely bang on, relentless central bank buying. Would you believe it by looking at the short-term chart chatter? No. And that's why we're going to really kind of drill in there and have a look. So we'll start by looking below the far too obvious end of week, end of month, COMEX driven chart painted selling, which obviously that was last Friday ahead of the US holiday, which came in on Monday. I'm going to look at the underlying bullish, massive de-dollarization drivers that are going to overrun these officially driven last-ditch attempts to try and stop gold breaking out above. And this is very important. We always look at the physical levels above very large reported central bank sovereign buy stops sitting at spot gold 25.50. Now, a buy stop is simply a strategy that if the gold price or silver price goes above a certain level, it triggers orders to buy, and the orders that can also be placed below the market. And it's like an one cancels other situation. Whichever one fills first, they're in.
Now we'll look at the live charts in more detail shortly, but really just to illustrate how close gold came to breaking out above massive buy stops at spot 25.50. And that is, the spot line is actually adjusted to reflect the December futures contract, because the December contract expires in late at the end of November and goes into delivery into the end of December. Obviously, there's a premium for that. There's a carry premium for that. So, but really, we track the COMEX footprints and the charts, because it really reveals the Fed's footprints much easier. But really, we make adjustments so that we illustrate just where these buy stops are. And really what we're trying to do here is illustrate where the physical levels are, whether they be buy stops above the market or orders below the market. And it really illustrates where the interventions come in, one after the other. And we'll look at those more in a little minute. So here is where we recorded our last episode. And I put that line here. It was between the AM fix and the PM fix. And this is where we're recording our episode now, is after the AM fix and just before the PM fix. Obviously, I'm doing the recording at the PM fix hour, so we need to get this done now. The pit has just opened, so we've seen a lot of selling coming in at each pit open, pit, and often that is where we see the interventions. And this is where the Fed operates in this market, in the futures market. So hence why we track it. I mean, really what we're tracking here is the 96% leveraged Fed and insider footprints. As I say, so this December contract reflects the time premium to December delivery, and it shrinks at about $1 every day. So by Friday, when this is released, we will see non-farm payroll volatility kick in, what that will do is place these buy stops actually around 25.78, just so you're aware of them. But look how close, look where the Fed stepped in. Just $11, $10 or $11 ahead of these central bank orders actually being hit. Now, these synthetic interventions have been limited to how many 96% CTA speculators they can shake out, which is what's been happening here. But in doing so, it's resulted in the COMEX-derived price has relentlessly been capitalized on by unleveraged central bank sovereign physical buyers, which ultimately drains the leveraged COMEX swamp of lifeblood liquidity. In other words, the Fed is digging another deep hole, and we're watching it in real time. Now, in a short while, we'll look at the live charts in more detail so as to connect the footprints between the last episode, which was recorded here, and now. And if you recall, this is where we recorded the prior episode, and we'd obviously brought ourselves up to date until that point there. So just so you're aware of what we're doing and why. So this is being recorded exactly 2 weeks later on Wednesday, the 4th of September, between the AM and the PM fix. And we'll look at how this AM fix this morning really created some huge short covering. So we'll look at that closer in a short while.
But first, Shane, so as to cover both the active traders' questions as well as the stackers' questions, let's put the bigger picture into context. And it's mind-boggling when you really drill down into it. And obviously, put that into context with the short-term chart chatter. And then we'll start by looking at the bigger picture. I think it really helps to put that into context. So last Tuesday, this story here that you can see on the Bloomberg terminal, it really piqued our interest. It cited Eurozone capital Stephen Jen warning of a potential avalanche of dollar selling as Chinese owners of dollars assets divest these dollars into Fed rate cuts. So what he said was, his words, think of an avalanche, he said. Well, by no coincidence, while not an avalanche quite yet, the dollar selling that we have evidenced is already underway. And while the mainstream has not yet made the connection, these so far stealthy dollar sales also jives with Beijing's officially reported gold purchases. It's a question of connecting the dots. But as you know, Shane, our focus is on the much larger unreported dollar-denominated, bilaterally settled, unreported monetary gold accumulation footprints, which our reliable contacts say are also transacted by state-held banks in proxy. So as the COMEX swamp gets slowly drained, these massive central bank flows of 400-ounce bars from west to east are being revealed.
Yes, Andrew, this is exactly something that very few people are reporting right now. And you credited Gainesville Coins for being one of the very few to dig into these very large monetary gold outflows. But to answer a ton of questions on this unreported subject, can you refresh us on the sheer size of these unreported central bank monetary gold purchases?
Yeah, it's huge. Shane, so especially as these unreported, as I say, bilaterally settled monetary gold purchases, they rail against reports that China had paused their central bank purchases. We kind of looked at that last time. I mean, this obviously suits China very well, as it opens up opportunities to prey on the blinkered, led by the nose COMEX traders being tricked by the Fed into regular as clockwork, throwing in the towel. And as we see again now, as we've seen it in the last few days, and really because COMEX momentum traders, they don't like sideways action. They want a direction, and they're just all in. They're not. There's no skin in, other than their 4%. There's no other skin in the game. They're just chasing momentum, and they're once again being gaslighted into coattailing the Fed into making blind bets against synthetic gold, something they would not do if they had any view into how tight the physical markets are. And once again, they're being set up as patsies. Now, to answer your subscribers' questions, though, Shane, we've previously assessed that only a very small percentage of these 400-ounce 995 dollar-denominated Basel III compliant monetary gold FX purchases are captured in the export customs data. And again, we credit Gainesville and the World Gold Council for their digging into this. But because these $1 million per bar transactions are bilaterally settled, then they land in any one of some 47 customs entry gateways alongside 4,000 customs clearance control stations. By design, it is impossible to track the scope of all the PBOC's monetary gold purchases, especially when they're purchased by proxy. Furthermore, imports of artisanal doré gold are hidden in the dollars for gold mix. PBOC buying of all home-produced gold is largely transacted in RMB, which, for reasons we will look at now, is expected to strengthen into an avalanche of dollar sales. Now, as Jen assesses, Chinese firms have amassed more than 2 trillion since the pandemic in offshore investments, parked in assets that really pay higher rates than yuan-denominated ones. And when the Fed lowers borrowing costs, the appeal of dollar assets erodes, and at best estimate potentially spurs, as he puts it, a conservative 1 trillion of flows back home as China's rate discount with the US narrows up. Now, as we assessed in our last few episodes, our liquidity providers have been confirming dollar selling to acquire gold, notably picked up in 2010, directly after the IMF refused to sell the PBOC the 200 tons of remaining IFM gold, which followed India being sanctioned to buy 200 tons directly from the IFM, the IMF, at $1,000 per ounce. Now, as we've since been tracking, these largely unreported monetary gold purchases, picking up after the dollar was weaponized against Russia in March 2022, much of it being transacted in very, very large oil for gold trades, but visibly and officially reported picking up in the last 18 months. That cannot be hidden. Now, however, given if we put this fresh de-dollarizing Fed rate cut aside for a moment, which is about to trigger an avalanche, as he puts it, of dollar selling, the de-dollarizing process has already picked up significantly ahead of October the 22nd BRICs gold currency launch. Now, while such an avalanche of dollar sales would also serve to support the yuan, as we drew attention to in our last episode, liquidity providers have also been reporting this very large pickup in direct bilaterally settled dollar-denominated monetary gold, 400 ounce, 995 bars, exiting largely London, also Switzerland, but largely. But we've also, in addition to that, there are as yet unreported fresh official gold purchasing that is occurring, and that'll be reported later, into an expectation of a strengthening yuan. It makes sense. And aside from what briefly appeared on the Bloomberg terminal, as yet, this story has not yet even gone mainstream, and I don't think it will. However, our well-connected Chinese contacts say it was no coincidence that White House National Security Advisor Jake Sullivan concluded a 3-day trip to Beijing last week, comprising of several meetings with Chinese officials, including Xi Jinping. And while the officially reported agenda, the items, they range from Beijing's warning against the US arming Taiwan, South Sea disputes, the aggressive sanctions on China, including those related to Ukraine. Election interference was one of the subjects. But really, the unreported elephant in the room was the BRICs-related de-dollarization avalanche referred to by Stephen Jen, and the realization that these dollar sales will largely be parked in first-tier physical gold. This puts the Fed, the only remaining global central bank betting against gold, between a rock and a hard place. Now, furthermore, the scale of this de-dollarization process is even then grossly underestimated. And if you recall, 2 years ago, we drew attention to a little reported 2022 Bloomberg news item that revealed former US Trade and Treasury official Brad Setzer. He was concerned that China's reported 3.24 trillion of foreign exchange reserves comprised only half of what he estimated as closer to 6 trillion, which he expressed as really, and his words were exactly, presenting a new risk to the global economy. He also revealed that China's deliberate lack of transparency posed the West a major problem, and he remarked, because China structurally is so central to the global economy that anything it does, seen or unseen, will eventually have an enormous impact on the rest of the world. Okay, those are his words. Now, Setzer's comments had verified our assertions that around half of these additional 3.24 trillion of unreported shadow banking reserves are salted amongst the state commercial lenders, which is what he says so. However, what he doesn't really clarify is that given that monetary gold reserves are also categorized as foreign exchange reserves, the only question we had posed our well-connected Chinese liquidity providers was how much of this massive multi-trillion shadow banking pile salted inside the state-held banks comprised of FX gold that had been converted into physical bars. Now, their assessments suggest the PBOC gold salted amongst the state-held banks had to exceed in excess of 40,000 tons. We talked about this before, which when added to the 25,000 odd tons of ring-fenced citizens gold, which gold that is sticky and cannot be exported, but in a time of war, Beijing could ultimately muster up combine those and muster up really essentially about 65,000 tons of gold, realistically. And then if you add in Russian and other BRICs gold, then the BRICs nations could monetize some 80,000 tons of gold. These are real numbers. And it's just a question of following the footprints. Think about this. weigh this up against the 8,134 tons of gold that the US Treasury lays dubious claim to. I mean, that's because it's so suspect, because of all the audit requests over the last 50 years, they've all been refused, which is ludicrous. Whereas this enormous disparity against this huge hoard of BRICs-centric gold, which actually comprises of 100% fully paid for physical gold, presents zero counterparty risk, unlike the Fed. So add this into the avalanche of visible Chinese dollar assets, the unfactored over 3.24 trillion of hidden, unregulated, bilaterally settled Chinese shadow banking reserves that Setster has exposed, then this avalanche is potentially so large it threatens to topple the 2 quadrillion derivative market, and indeed presents a risk to the global economy, unless, that is, the Western central banks, including the Fed, revalue gold, which, other than starting World War III, deliberately triggering that, revaluing central bank gold reserve accounts is actually a very simple procedure. Now, it does concern me that they may want to start World War III, because the US dollar hegemony, unipolar US dollar hegemony, is toast. Now, given Setster currently sits on the board of the Council of Foreign Relations, which is a body that GATA has exposed, particularly Chris Powell has drawn a lot of attention to the fact this is an organization they've exposed as being one of the primary actors behind the last 50 odd years of dollar gold interventions. And it's not surprising this golden elephant in the room was hidden. But China is threatening to break its chains. Now, the reason I wanted to revisit this shadow banking subject again now is the sanction crosshairs have aggressively shifted to China. And while they hold all the de-dollarization cards and an upcoming BRICs currency to play them into, there is no requirement for the PBOC to employ the financial nuclear option of dumping US treasuries, officially dumping them. However, that's one hell of a big hammer to hold. So instead, it's simply incentivizing Beijing to move from stealth to pushing back against the US current. And the US is operating a carrot and stick approach, which is exactly what that visit to China backfired on the US last week. You can't do that. You don't have a strength of position. And so anyway, so this carrot and stick approach really trying to stop the conversion of these dollar assets. But what it's going to do is reignite, it has reignited the not yet reported official buying, which will later be reported as having been triggered, alongside continued bilaterally settled 400-ounce monetary gold shadow banking purchases, which are off the record. Now, given Basel III NSFR standards have recategorized gold as a competing first-tier asset class, it forces the West when we see the buyers coming in, the AM fixes, the PM fixes, it forces, but primarily the AM fixes, which are really Asian facing, it forces T+1 delivery of synthetically undervalued global FX gold purchases, emptying Western vaults into the PBOC's state-held bank coffers.
Now, Andrew, this is absolutely huge. As you say, the weaponization of the USD, fresh US and EU sanctions against China are driving Beijing to focus it on its trade with a rapidly expanding group of BRICs nations traded in the currencies of these nations. From what you were reporting, it suggests that last week's US visit to China may have further inflamed tensions. What are you hearing from your contacts on this topic here?
Yeah, Shane, when you think about it, the sheer arrogance of that US unipolar carrot and stick approach, China anchors and faces the multipolar BRICs nations. And this is the global majority. who produce or consume something like 85% of all the global trade. Amongst themselves, China has become the world's largest trading nation, period, dominating global trade, just as its share of US trade in dollars is actually contracting. So there's not a strong position for the US to play against. And while Westerners focus on the intraday and intra-week market swings, gold I'm talking about, and other markets as well, China takes a more pragmatic, longer-term view. And with all lessons learned following the weaponizing of the SWIFT banking system against Russia in 2022, China is increasingly encountering friction relating to Taiwan and facing down the US in the South China Sea too. And these geopolitical escalations are not going unanswered. Not just what we see in the currency crosses where China swaps dollars for NSFR compliant gold, but China is now also sanctioning US businesses providing arms sales to Taiwan.
Now, we looked a little while ago at how we make adjustments to really the most important is the FX gold price, which is NSFR compliant and a first-year asset class. Whereas, and it's unleveraged in the sense it has to be physically deliverable. So what we also do is we track those lower down. So this 25.3150 happens to be today. Again, it's contracting about $1 a day, but currently today at this hour, it is currently the 2500 spot, which is where central bank bids are also sitting and have been triggered and will also be triggered again on the way back up, is at 25.3150 today. Now, I think what's interesting, and we'll look at the reason for this as well, we have not seen, up until today, we have not seen a single AM fix, and there's been 11 consistent AM fix, all the way up to today, 11 all above 2,500. Why? Because they were trying to front run them. There wasn't enough. What they had to do is wait for the stock market to really crash for CTAs who use gold as a first tier asset class, in other words, a hedging mechanism for their risk positions, and into the stock market sell-off, which we've seen here. What we've seen is also, and this is silver, but it's the same with gold. We've seen, obviously, what they've done is use those hedges, sold these hedges to protect this fall. So they're using gold for what it should be used for. And even though, in this case, it's synthetic, it's leveraged, but so are their positions on the stock market. So this just happens to be the S&P. But just trying to explain, how these hedges work. And we see the same in gold, where you can see the collapse in, and this happens to be S&P again in gold, NASDAQ as well. Watching, and this is where what this selling is actually CTAs ditching the hedges that they had in place to protect these falls. So really, what they've done is literally squared up positions here and squared up the hedge. So with that explained, aside from the sanction proofing mandate, gold price in dollars at prices below $3,000 are viewed as grossly undervalued. And it was no coincidence that the historically thinner Asian-facing AM fixes that we've seen 11 in a row above 2,500, in other words, 2 solid weeks of AM fixes above, because they're Asian-facing, what they've done, what's happening here is they've evidenced large Chinese and Indian-related buying. And despite all the gaming following massive buying evidenced into the stock market sell-off triggering these gold hedges being dumped on the 16th, the same thing happened on the 16th of August in stocks, where we saw this dip here, and it was exactly the same situation, similar situation rather, And then, of course, we saw the hedges being dumped. Now we're already seeing, even though stocks are selling, we're seeing some safe haven buying coming in. So it reaches a level. But really, I guess the point I'm trying to make, since the 16th, it has taken, and there's the AM fix here, since the 16th, every single one, 11 in a row, bar for today's, fixed above 2,500. And it took 12 sessions for the COMEX swamp to dump enough paper market supply to allow Asian buyers, who are very, very happy with this, to fill their boots again this morning. That's the first time since the 16th. This means that despite every attempt by the Fed to try and call a paper market top, which they've attempted to do here, FX gold has been alchemized by an all too savvy physical market. And there's no damage being done whatsoever. In fact, liquidity providers see no nearby price ceiling to the gold rally that commenced 7 months ago on February the 13th. We circled here and we've looked at it multiple times. That was from $2,000, breaking out into the near vertical stair step that was ignited when the SHFE opened for business on March the 1st. So to kind of sum up, while Russia has largely divested itself of dollars back in June 2021, all the way back here, openly announcing they were removing dollars from its national wealth fund, as of this March, China's State Administration of Foreign Exchange, that is SAFE, reported holding. Actually, I've just jumped ahead here. I'm going to talk about the SHFE in a minute, but what we're really talking about first, and it just happens to jive with this SHFE launch in March. China announced that the State Administration of Foreign Exchange, SAFE, had reported holding 3.25 trillion of US dollar assets. And while at the margin, it served them not to openly dump dollars, it is the 3-odd trillion of unreported shadow banking reserves that are surreptitiously being exchanged for bullion in large tonnage size. Now, our very well-connected Chinese contacts have for some time been reporting these stealthy dollar gold conversions. The PBOC gold buying mandate commenced in 2010, and it was right around here. And it kind of ramped up significantly after the dollar was weaponized against Russia in March 2022. Well, what I keep wanting to draw attention to is that the gold buying stepped up significantly on the 1st of March. And while this stealthy de-dollarizing mandate coincided with Beijing's well-timed launch of the SHFE futures exchange right here, by design, these speculative futures buyers were assistive in driving up the value of the plus or minus 60,000 tons of combined official and citizens' gold reserves. So the PBOC's actions are really the opposite of the Fed's mandate to suppress the price of gold. Now, while reported Chinese retail gold buying came off the boil in May due to the record high RMB gold prices, it suited Beijing to assist in spinning the story, and now it is becoming clear that they've ramped up their monetary gold purchases, which, as we reported at the time, were unseen. There is no doubt that this is the concurrent drawdown of central bank demand. It's tightening available physical supply, which is why it forces the offers to sell physical gold to keep rising, which we see time after time, and we see it again now. And of course, this counters reports that gold is synthetically being driven higher simply by large options derivative bets. In fact, these SHFE bets appear to be supportive of the BRICs gold appreciation mandate. This is not a coincidence. China sanctioned that for a reason. China has so far not needed to invoke the financial nuclear option of revealing the real value of its gold reserves, currently salted amongst the state-held banks, but it will soon have to lift the lid on the Sino-Russia gold reserves that provide the anchor liquidity to the 40% gold, 60% BRICs member-backed Enbridge token. It is this revelation that will invoke Western-facing banks, including the Fed, to revalue their gold reserve account bullion holdings to market, likely in the range of something like 2,700 to really 2,700 to 30 to 3,000 bucks. It's one of those two. We don't know. But given the avalanche of de-dollarizing, I would think the higher market, the higher price jives with what we're seeing from now first-tier banks talking about $3,000 gold.
So given current geopolitical escalations are accelerating alongside the BRICs Enbridge settlement currency and Glasnev's yet to be launched but beta-tested option 2 commodity currency, Russia and China are simultaneously opening up fresh sanction-proof trade routes to plug into these increasingly liquid non-dollar denominated clearing systems. It's clear that the de-dollarization process is rapidly escalating, yet none of this is factored into the paper price of gold. And following the BRICS October 22nd summit, we would expect to see Western-facing central banks revaluing gold, and that to be implemented well ahead of the fourth quarter.
All right, Andrew, thanks. Now, it's good to keep abreast of these underlying factors, especially as we see officials desperately trying to rinse out and wrong foot as many naked long CTA speculators as possible. Can you tell us what you're seeing here in the short term?
Yeah, Shane. So very short term. Now, this increasingly weak official hand, it's weak because look at the timings of these things. They are, and we're seeing midnight sells. We're seeing pit open. Look, pit open to pit close sales. It has to be conducted during purely the synthetic session. We see it a time and time again. We're seeing it again today. Pit has opened, and what are they trying to do? They're trying to simply paper it down. They're going to run out of sufficient supply. What they're doing is letting the insiders, the physical buyers, load the boat, and insiders to cover their short bets. So what they're allowing the global South central banks to do is to load up Western gold into a closing window before the formal BRICs currency launches in just 30 market sessions from today. Now, this buying was hidden in plain sight over the last 2 weeks, yet our liquidity providers report that every single Asian-facing AM fix had such large limit order bids populated sub-spot 2500, officials had generally front-run them being filled. And while insiders are trying to game as much uncertainty as possible ahead of non-farm payrolls on Friday, the Asian-facing AM fix today was an absolute gift. Now, it's pretty clear the end of the week, end of month selling that we saw on Friday ahead of the market, the thin market holiday, that had to wait for really the AM fix at that point to clear before they smacked it down. But as we've just pointed out, the CTA stop hunting selling always commences at the pit open and then usually waiting for the fix to settle before known central bank bids, looking for a tag of 2,500 at the PM fix really look to fill. They then short cover, but only to the extent that they can short cover into CTA capitulations. Now, these old tactics may trick out 96% leverage paper traders to settle their paper bets for cash, but outside the bubble COMEX world, the gold is actually being settled by way of physical delivery, capitalizing on these synthetic discounts. Now, look at the farce in silver. Really, the real target was the in-delivery September silver contract, which went off the board but is now in delivery. Now, this is the December contract. So the September contract is actually, they have basically a full month to the end of this month to deliver on that contract. And we've seen this contract backwardated by as much as $13.80 to spot. So, I mean, that is a huge, huge backwardation. And right now we're looking at it, it's around about 6 cents, just around 6 cents, but it's been as high as $13.80. So you can see that this is the spot price right here. And this is the fact that it's actually, the spot price is above the September contract. That means that they're having trouble getting out of that contract. So yeah, it's volatile, but we've seen it as high as $13.80. That should not be happening. And we saw 596 tons of COMEX deliveries into the spot premium, illustrating the selling is COMEX driven into a consistent spot silver premium. Insiders have managed to rinse out sufficient specs to start short covering into these guys sub 28 spot. Now 28 spot is because there's a 33 cent premium in the December contract to spot because of the carry cost, very similar to gold. So that is that's the round number here. We've seen it breached yesterday. We've seen the COT cutoff. We've seen it breached again, and now we've seen it this morning, and now we see it again above. This two-way action here is just really allowing the insiders to short cover. Really, this is a joke. Given how strong Indian and Chinese silver demand is, this action is a farce. But outside the paper-settled casino world, silver is shouting out an opportunity. Where do we think the worst-case scenario is? Well, we see short covering now here, but really the top of the range was around about 32.28. And again, I've stripped these charts down so that we're looking at just the main drivers. But I think that this would be probably this confluence here of this outside trend line here, which is actually a 25% trend line of this fork, and this 25% bull pivot. I think that's probably the worst case scenario. I would certainly think that would be, if you're a stacker, that's probably not a bad place to be looking. I don't know if they're going to dare do that. This is the action reaction line. Just so you know, the stops in silver, we've looked at the stops in gold. The stops in silver at 32,750. Watch out above once they get cleared, and they will get cleared.
So really, in summary, Shane, as we drew attention to really during the last week of the first quarter, if you remember, when we were watching the breakout occur in gold, we'd noted a distinct change in behavior back then around the Asian-centric Chinese-driven AM gold fixes, which we've kind of looked at in the charts. With Indian buyers having switched horses to silver at higher gold prices, we began evidencing very aggressive Chinese buyers populating this fix. Since then, this action around the usually thinner AM fixes telegraphed an impossible to ignore change in behavior. And with these buyers surgically attacking the paper gold cartel's mantra of selling paper gold at every pit open in the hope they could suck in enough coattailing CTAs to take the bait. And as we've increasingly drawn attention to, the Fed's officially driven paper gold price suppression mandate has become far too obvious. And obviously, they're in a position between a rock and a hard place. They're actually serving up the only thing they can serve up in defense until they revalue gold. They are just simply being gamed. And all of this, their efforts are being capitalized on through the exchange for physical conduit, providing a backdoor to the COMEX to allow the exchange of non-compliant 96% leverage COMEX open interest to be forced to be fully funded into NSFR compliant physical gold bullion in London and Switzerland, etc., etc. Now, this constitutes a huge unwind of COMEX leverage, and at the margin, it's limiting the scope of the Fed interventions, hence the series of higher stair steps. Now, given the breakout gold rally that commenced in February has been assisted by SHFE buying, it's largely been driven by invisible over-the-counter related monetary gold transactions. Sorry to go on about it, but this is so big, it's just not anywhere. It's not being discussed anywhere. What's confusing the analysts trying to understand the gold rally is that while there has been an increase in the LBMA CME centric flows, they just don't jive with the scale and the rapid gold price rise, and namely what is officially flowing into the central bank coffers. Now, they think it's gone on pause in May. It hasn't. The entire issue leads back to the mainstream media still not understanding the implications of gold being reclassified by the Bank of International Settlements as a first-tier asset class on the 1st of January 2023. This event is what opened up a large increase in unreported bilaterally settled central bank and sovereign monetary gold demand. This means that central bank, sovereign, and institutional bilaterally settled spot gold over-the-counter buying now has to be deliverable. And by its very nature, it's unreported. This opens up spot gold over-the-counter gold purchase to feed central bank monetary gold purchases. The lion's share of this monetary gold is being accrued by the BRICs-related Sino-Russian Gold Alliance, which was established in 2013, but has waited for the fourth quarter to actually pull the trigger. This will be looked back on, that these central bank purchases were being coordinated in concert with Russia and China formally launching the tested BIS-sanctioned MBridge platform, alongside the absolutely Russian-centric, green-lighted BRICs gold-backed commodity currency, the one that Glasnev outlined. They will trade in tandem. Both will be formally tabled at the BRICS October Kazan Summit meeting next month. Well, guys, at risk of overstaying my welcome, there's only one question remaining. And yes, of course, it's Robert Kiyosaki's question. How much physical gold and silver do you own? But as Bill Halter said in our last episode, it should be a priority to get your assets out of the system as soon as possible. As he says, before it's too late. So thanks, guys, and we'll see you again at the next episode.
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical, make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. Don't be fooled. They're not the same. All right. So there you have it. That's all we have for you this week on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button right there if you haven't already done so, sharing this information, and if you haven't already subscribe to the channel. And if you click on that bell right there, we will notify you as each episode goes live. And with that, we will see you right here next time on Live from the Vault. See you then.